Welcome to Flippening, the podcast for cryptocurrency traders and investors. I'm your host, Clay Collins. Each week, we discuss the cryptocurrency economy, new investment strategies for maximizing returns, and stories from the front lines of financial disruption. Go to flippening.com to join our newsletter for cryptocurrency investors and find out just why this podcast is called Flippening.
Clay Collins is the CEO of Nomics. All opinions expressed by Clay and podcast guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions.
My guest today is Aaron Brown, former managing director and head of research at AQR Capital Management, which is the world's second largest hedge fund with $63 billion under management. Aaron is also the author of The Poker Face of Wall Street. Today's conversation is a deep dive into the topic of crypto derivatives. This is a timely discussion for a few reasons. First, the CME Group, which is the world's largest regulated FX marketplace, recently announced that it would facilitate trading of Bitcoin futures. Many believe that this announcement has been the catalyst for the huge gains we've seen in the price of Bitcoin in October and November of this year, and that the floodgates are about to open to a wall of institutional money about to pour into Bitcoin and other cryptocurrencies. During this episode, we talk about Aaron's thesis when it comes to cryptocurrency investing, the different kinds of derivatives, and how they work. We also talk about the difference between the crypto derivatives products offered by LedgerX, CME Group, and Cboe, and how these products differ from unregulated offerings from companies like BitMEX. I should note that in this episode, Aaron reveals which of these exchanges he prefers and which one he would trust most as a trader when it comes to trading crypto derivatives. We also talk about how crypto derivatives affect the price of their underlying assets, and why there has been regulatory approval for crypto derivatives to date, but no approval yet for a Bitcoin ETF. One of my favorite parts of this interview is where Aaron explains the SEC's regulatory process and standards, and how these standards differ from the CFTC's standards. And by the way, CFTC stands for Commodities Futures Trading Commission. Please enjoy my conversation with Aaron Brown. I'm joined today by Aaron Brown. Aaron has written a number of very astute pieces on crypto derivatives and the potential impact that they'll have on the cryptocurrency ecosystem. Hey, this is Clay cutting myself off here to provide some context on the word crypto derivative. If you're not totally sure what a derivative is, it's a financial contract whose price is anchored to another asset. So crypto derivatives are derivatives whose price is tied to one or more crypto assets. One might purchase a Bitcoin derivative at the price of a Bitcoin. Now back to our interview. Aaron, thank you so much for joining me today.
Good to be here, Clay.
You know, before getting into this, I think our listeners would love to hear a little bit about your background and the path that you took to finance. Could you tell us a little bit about that?
All right. I was born in 1956 and I was raised in Seattle. And the late 60s, early 70s were a very unsettled time for a lot of people. And people had different reactions to it. In my case, I kind of became obsessed with money, not with getting rich, but with kind of having enough that people left you alone. It just seemed to me like, people who paid their bills and cut their grass were okay. I was raised in this middle-class suburb. And if anybody, lost their job, lost their money, which happened a lot to people in those days, they just kind of quietly moved out of the neighborhood and nobody ever spoke about them again. And this struck me as just, really scary, kind of Twilight Zone sort of thing. I was a very shy kid, but I loved numbers and I loved, reading the newspaper from the back where I had the sports pages, the financial pages and so on, because it had lots of numbers. And I got very interested in gambling, specifically poker. I got very good at poker. And so at age 14, I walked into the basement of a local tavern and I was terrified. I sat down at a table, I took people's money, and I left. That was just a, seminal moment for me. That said, okay, whatever else happens, you can find a poker game anywhere in the world. You can make enough money so you're going to eat, have a place to stay that night, and that's it. And then, the worry about money went away. I never had any urge to pile up huge amounts of it. I just wanted to know I could get enough to get by. So that led to, a lot of interest in gambling and blackjack and sports betting and so on. And I kind of supported myself with that stuff for a while. I also was very interested in theoretical statistics and mathematics, so I studied a lot of that. And sometime in kind of the late 70s, I got the idea, and a lot of people in my position, there were a lot of people like me in those days, kind of people who had been, you might say, kind of tossed out of the mainstream economy, academic world, just didn't make sense to them in that crazy time, and liked the independence of making money by, betting with their brain. But anyway, a lot of us decided that finance was easier than Las Vegas. So we moved into finance, and, we were pretty successful there. But then we learned, there's a lot more to it. There's a whole new level of stuff you have to learn. So eventually, and this was primarily due to the crash of 1987, just taught me a lot about finance. Not that the stock market could go down a lot, that financial markets could completely realign and nobody notices or says anything about it. Kind of like those people who disappeared from my neighborhood back when I was a kid. So I went into risk management. I went back, actually, got a faculty position teaching for a few years, and I also did some consulting and so on. And eventually came back and reinvented myself as a risk manager, financial risk manager. This is back in the early 90s when we're inventing this stuff. And I then had a 25-year career in risk management, the last 10 of it as chief risk officer for AQR Capital Management, a big hedge fund. And last June, I decided to simplify my life, working on a couple of books and doing various odds and ends of things that interested me that I could never do when I was working, either for compliance reason or because I didn't have the time.
Do those activities include, writing, stating your opinion on various financial outcomes, that kind of thing?
Yeah, I've always had opinions, and I'm often wrong, so I always warn people about that. I hope I'm right 51% of the time. Yeah, I've always done that. I do it for Bloomberg mostly now. I was doing it for Minionville, for Sage, Usenet groups back in the early 90s.
When it comes to cryptocurrencies and cryptocurrency investing, I know you've stated in your Bloomberg pieces that you are a holder of a basket of cryptocurrencies. Do you have a particular, hypothesis that you're following there? I know recently everything just seems to be up, but there's a number of different approaches one could take. Are you open to discussing kind of publicly how you're letting this all play out?
I am, although I may disappoint people. I have no particularly sophisticated view. I compare it to back in 1995, I did the same thing with the internet as I did in 2011 with cryptocurrencies. I said, okay, what portion is this going to be of the economy in 20 years? And with the internet, I guessed 5%. And with cryptocurrencies, I guessed 2%. And so I said, okay, I just want to keep 5% of my assets in 95 in the internet. And in cryptocurrencies, it was 2%. And not only don't I know, which companies or currencies are going to survive, I don't even know that anything that's available now will be around in 20 years. But if I keep investing in it and I keep up with the new things as they come up, and, I just try and keep a diversified portfolio, roughly reflecting, the value of all the things that are available in the sector, then I'll pick up the good new stuff as it comes up. And in the end, I'll do okay. And this is not a get-rich-quick thing. Cryptocurrencies, if cryptocurrencies double every year, for example, somebody who puts $1 in and keeps it in for 10 years has $1,024. Me, because I keep 2% every year, that just means I add 2% to my portfolio return every year. But that's the kind of return I'm going for in this. So I'm not a high-risk, sell your house, put it in cryptocurrencies kind of guy. I'm saying, look, it should be part of your portfolio. It might go to zero, so you should put a part of your portfolio you can afford to lose. But it has enough potential, especially it has potential in scenarios where a lot of other investments don't do well, that it reduces your risk and enhances your long-term expected return, in my opinion. And as I say, I'm often wrong.
So essentially holding a basket of top cryptocurrencies, an amount you're willing to lose, and then periodically rebalancing as the ranking shift. Is that a good summary?
Yeah, the rebalancing is critical. If you don't do that, if I put 2% of my portfolio in cryptocurrencies back in 2012, which would have been essentially all Bitcoin at that time, and held on to it, now it'd be, 75% of my much larger portfolio. And I'd be, totally invested. And if it went down to zero, I'd be, be a big financial setback.
You'd hold way too much Dogecoin.
Yep. By rebalancing periodically, you take advantage of the volatility. Instead of being exposed to this tremendous volatility of this very uncertain asset class, when it goes up, you make money because you're selling on the up. And when it goes down, you buy in. And the more volatile it is, the better you do.
Right. That makes sense. So perhaps maybe buying things like Neo and IOTA when they first kind of appear on the radar, at least near the top 10. And of course, you paid a lot less for them. But, if they get close to the top 3, it actually becomes worth quite a bit. That makes a lot of sense. Let's get a little bit to your personal economic views. I know a lot of people in this space are fans of Austrian economics. Are you like a Mises fan? What particular philosophies do you find yourself aligned with?
Yeah, well, a lot of people say they're Austrian economists, but then if you ask them if they've actually read von Mises and some of these other people, they're really, really boring to read. And the thing they're most concerned about is how does money establish its initial value? However, it is very interesting. We're now seeing an experiment, with cryptocurrencies, which is exactly the experiment these people were arguing over 150 years ago. If a new currency showed up de novo, how would you decide what it was worth?
It's great to see this all playing out in a very real laboratory right now. It doesn't get much more real than what's happening currently.
Yeah, economists complain that they can't do experiments, but, here we really have a nice, clean experiment. We're going to learn a lot about what money actually is. The first time it got invented, there were no economists around to record it. So now it's being reinvented, and we have a chance to find out who's right.
I guess let's move a little bit to this nice wrapper that's being put around at least Bitcoin right now to allow institutional investors to get some exposure to this, I guess, starting first with LedgerX and then sort of the declaration by CME Group and I guess it's pronounced Cboe Global Markets to allow crypto derivatives. So this is a really interesting development and brings up a lot of questions about the differences between what the SEC is looking at versus the CFTC. Hey, this is Clay, again, cutting myself off here to explain what the CFTC and SEC are. The CFTC and SEC are essentially different agencies of the U.S. government. The U.S. Commodity Futures Trading Commission, or the CFTC, is an independent agency of the United States government that regulates futures and options markets. The SEC, or Securities and Exchange Commission, is a government commission created by Congress to regulate securities markets and protect investors. So part of the mandate of the SEC is to protect investors, and the CFTC, which regulates commodities and futures and options markets, is generally less concerned with protecting investors. It brings up a lot of questions about derivatives and what impact they have on their underlying assets. I think it's a great entry point into all of this. I also think it's interesting to kind of track gold's sort of progress towards becoming an ETF. I believe, although correct me if I'm wrong, that it kind of followed a similar path, being traded as a commodity first and then movement towards an ETF after regulatory approval. What do you make of crypto derivatives in general and what's happening right now?
Yeah, well, first of all, it's very important. There's a tremendous difference between LedgerX and Cboe CME. Cboe CME have announced a plan to offer cash-settled derivatives. And that's kind of like, you and me betting on who's going to win the Super Bowl. It really doesn't have any effect on the outcome of the game. We're just exchanging cash with each other. LedgerX is actually having physical delivery, which is a much bigger deal. And another way to think about this is, CME and Cboe, from their name, the C in both cases stands for Chicago. These are, Mid-America futures exchanges, commodity-based. That's the tradition they come out of. LedgerX is really a combination of the coasts, New York and Silicon Valley. It's fintech. It's got real financial people and real venture capital people involved. So people who are kind of more native to the Bitcoin space.
Hey, it's Clay again here to explain what futures are. Here goes. Futures are financial contracts that obligate the buyer or seller to buy or sell something at a future date. Some futures contracts may call for delivery of the asset itself, while others are settled in cash. Back to Aaron.
If these things occur and you get significant trading, so LedgerX is open for business, but we're really seeing, I think, test trades and maybe some, people doing a little fun speculation. We're just not seeing the kind of volume that would mean institutions are really using it. CME and Cboe haven't opened yet, but if it attracts real institutional interest, then we're going to see a sea change in Bitcoin specifically, but I think in cryptocurrency in general. It means real money is coming into the sector. And my guess is it would take something like $40 or $50 billion of real money being invested to give stability and liquidity to the sector. So right now you got roughly $190 billion worth of market capitalization of cryptocurrencies, about $120 billion of which is Bitcoin, and the other is mostly Ethereum, Ripple, and a few other big ones. But nobody spent $190 billion or $100 billion or $10 billion on cryptocurrencies. All of that is value extrapolated from much smaller amounts of purchases. Most of the cryptocurrency in the world is held by founders. It's held by people who bought in at very low prices or miners in large blocks. So we don't really know when or if assuming it never happens, if institutional money really comes in, if there's an ETF, if it gets put in pension funds and sovereign wealth funds and so on, what the true demand and price is. And it could be very different from what it is today. And it could be higher and it could be lower. A lot of people think, once this connects up, Bitcoin will skyrocket in price. It could, and it could go down. But whatever that price is, it will be a real price. And since we really have not seen a real price for Bitcoin ever, it started out at about 1,300 to the dollar, and that was kind of a made-up number. And then it's really been a made-up number or something extrapolated from very low-volume transactions.
Right. So much of the, I guess, overall market cap is being held that we don't see enough kind of turnover in the asset to get a real sense of what it's worth. Of course, nobody would be willing to come in and buy all of Bitcoin like a traditional equity acquisition of a company. But I think your point is very well taken, that until we see real volume, it's hard to kind of know where the price will settle.
The sobering thing to think about, if you got $120 billion together and you bought all of Bitcoin, it would be worthless.
Right.
Nobody else would have bought any. So that's the interesting thing about money. It is valuable because you can't or you don't buy all of it. It's most valuable when it's dispersed into lots and lots of different hands.
Right. And I think that's one of the most interesting things about Bitcoin is that it didn't start off as one of these advanced financial instruments that only people with deep pockets had access to. It started out in a pretty distributed way, and it's working its way kind of upmarket rather than starting upmarket and then maybe working its way downmarket like a lot of other financial instruments or, asset classes have. Like, VC, for example, starts off upmarket, accredited investors, people like that, and then at some point it goes public, right? But this is kind of going the other direction. Maybe that's a bad thing with some of these ICOs.
One of the interesting things about Bitcoins is the founders were very explicit about that. They wanted to, have it decentralized. They wanted to have it democratized. However, I think inadvertently they created these miners, and the miners who were in, originally the idea was, all these hobbyists on their home computer would, generate a few Bitcoin. But now that turned out to be a really big business. Subsequently, many of the later cryptocurrencies have been deliberately designed to avoid doing that. Also, a lot of new, cryptocurrencies, you give huge allotments to the founders, which actually I think destroys their value in many cases. But, Bitcoin really didn't, although, the founders are pretty rich in Bitcoin space. So you have this big concentration of Bitcoin held by people who don't want the price to crash, but who I think would be very willing to sell half their holdings at current prices if they could do it without changing the price.
That makes a lot of sense. So the prices recently spiked quite a bit. I think I saw $7,000 this morning per Bitcoin. Some people believe that this has been in a large part affected by the CME Group's announcement, LedgerX. It looks like the institutional money is coming. And then, of course, there seems to be a price spike at the end of the year, every year here for a few years in a row. So I guess my question is, as the former, kind of head of risk at a large hedge fund, when you think about executing a large block trade purchase of Bitcoin on one of these exchanges, how do you weigh out where you want to put your money? Like LedgerX is newer, so maybe there's a little bit more counterparty risk, but you actually have the underlying assets held as collateral. And then CME Group is, much more established and well known and probably used to working with larger funds and, probably has people who fly around the country having steak dinners with all kinds of people. How do you analyze this landscape, and where would you execute a trade if you were with a large hedge fund?
Okay, well, Clay, I have a very definite interest to answer to this, but I want to make clear at the beginning, I have no financial interest in CME, Cboe, or LedgerX. I've actually been at all three places. I know some people who work there. I went and spent an hour with the heads of LedgerX and so on. But I'm telling you what I believe, not talking my book here. I would never deal with the CME and Cboe contracts as they are, planning to do them. They're cash settled based on indices, and those indices are very unreliable. The Cboe, the big problem is it's subject to manipulation. If you're going to do $100 million trade in Bitcoin, and then you're going to have it settled on the basis of some auction, which $10,000 changes hands, there's just way too much opportunity for manipulation. CME got around that by using a different method, which is less subject to manipulation, but is also more divorced from the actual Bitcoin price. And the CFTC, which regulates both of them and also regulates LedgerX, the CFTC has traditionally concerned itself only with contracts being settled according to the promised terms. They've never thought of themselves as having to protect futures traders. Futures traders are supposed to be, sharks who can take care of themselves. And so the CME didn't really concern itself with, will these contracts pay off in something that could actually be used to buy the Bitcoin you think you're getting exposure to. The SEC, on the other hand, has completely the opposite approach. Their mandate has always been to protect investors, to stop them from being cheated. So the SEC has refused to approve Bitcoin ETF, not because of any of the reasons most people think that, Bitcoin's a big fraud or Bitcoin used for illegal activity. It was only because they didn't believe the cash settlement prices, and the Winklevoss twins who wanted to open a Bitcoin ETF were going to use the same index that the Cboe is using. They just didn't believe it was, they thought it was subject to manipulation, to insider trading, to all sorts of abuse. So if I'm going to do a big transaction, I have to do it through LedgerX. I have to be sure the Bitcoin are really there. I want to make sure I'm actually investing in Bitcoin or selling Bitcoin, not getting some cash settled thing that may or may not be closely related to the Bitcoin price. The flip side of that, the trouble is, that means people have to deposit hundreds of millions of dollars worth of Bitcoin in the LedgerX clearinghouse. And so far, nobody seems willing to do that.
Right. There's lots of custodial issues which tend to be it.
No, not actually. I think LedgerX understands cryptocurrency. They're not necessarily, futures experts or commodity experts, but they really have set it up right for that. But it's a chicken and egg, Nobody wants to be the first if you deposit your Bitcoin there, there's nobody to trade with. So you need a buyer and a seller. And until people really have faith in it or decide to do it. By the way, it's possible that the problem is there really isn't all that much institutional interest in this. People assume that, it's being held back by discouragement from the Securities and Exchange Commission or unfamiliarity with the product. It may just be that Wall Street isn't interested in buying a lot of Bitcoin, which would, tell us something.
The Lindy effects haven't gone into effect yet.
Yeah, I think we find out in the next few months. If LedgerX stays open and there's no technical glitches or big regulatory problems, and it's still doing, a couple $1 million of business a week, then we can say, okay, Bitcoin is not going to attract Wall Street interest at this time.
That's really interesting. So I think pricing, we could probably spend an entire hour just talking about pricing and perhaps pricing for derivatives in particular. But could you share a little bit more detail about how LedgerX does its pricing and how that differs from how CME Group and Cboe price Bitcoin?
Okay, well, LedgerX doesn't have to price, right? So LedgerX, if you want to, let's say you want to do a day-ahead swap to buy Bitcoin, you have to deposit, you agree on the price with the seller, and you deposit the funds, and the seller deposits the Bitcoin, and LedgerX stays out of it. CME and Cboe have to agree on a price at delivery date because they're cash settled. So if you buy your Bitcoin, let's say you buy Bitcoin at $7,000, and at settlement time, the market price for Bitcoin is $8,000, then you have to you get paid $1,000. You don't get the Bitcoin, you get paid $1,000 because the price went up. But somebody has to figure out what that $8,000 is. And so Bitcoin and CME both use essentially an auction process. Cboe uses a New York State exchange that just conducts an auction. So everybody wants to buy or sell Bitcoin, come here. The problem is that auction is pretty small. You know, if you have hundreds of millions of Bitcoin were being transacted in an auction every day, then you have some faith in the price. But if it's $2,000, then, who knows? CME is using a London company that does a much more sophisticated international, looks at lots of exchanges, and does some analytics on it. So it's not as subject to manipulation. It's more like the LIBOR rate. As you may know, we've had some problems with the LIBOR rate. It is not subject to manipulation as easily in the sense of some individuals coming in and tainting the auction, but it's not as transparent. It's done by this group of people in London, and, they could have various motivations or beliefs that, are not widely shared. You don't really know. Is
LedgerX, does it have a USD to BTC pair, or is it purely BTC to BTC?
The basic product of LedgerX got in the news for offering options on Bitcoin, but the really important product from an institutional point of view is they have day-ahead swaps. If you want to buy or sell Bitcoin and you don't want to go to a bunch of exchanges which may be unregulated, and you do 1 Bitcoin here and 5 Bitcoin there, and you're not really sure about the money, you might be dealing with drug dealers or terrorists, you have no idea. If instead you go to Bitcoin and do a day-ahead swap, the cash is going to be there the next day, and the Bitcoin is going to be there the next day, and you know exactly who you're dealing with.
Let's back up and discuss derivatives a little bit. I've heard quite a few financial purists just go on tirades about derivatives. Derivatives were blamed, especially unregulated derivatives were blamed in part for the housing collapse of 2008. Why derivatives, and what are your view on derivatives and the utility provided by them in this use case?
I sort of go back to Warren Buffett's 2002 famous pronouncement in his Berkshire Hathaway annual report that derivatives are weapons of mass destruction. And he gave a number of reasons, all of which only apply to certain types of derivative. He was absolutely right about those, and those are the kinds that cause disaster. And they're the ones that are long-term ones for which the settlement price is unclear and that are not collateralized. Now, the kind of derivatives we're talking about for LedgerX and both CME and Cboe are completely collateralized. LedgerX is 100% collateralized. Cboe and CME have very good daily processes for ensuring collateral is there. The LedgerX one has no problem with the price setting because it's actually got physical delivery. Cboe and CME do have some problem of price, but because it's only a one-day issue, I don't think that's going to be a real problem. I think what derivatives are going to do for cryptocurrencies is there's kind of two big users for them, and they kind of offset. They could trade with each other. You got miners who hold huge amounts of Bitcoin. They like the upside. They want to hold Bitcoin. They believe in Bitcoin. They actually have, many of them that I talk to have more than 100% of their wealth in Bitcoin. If their Bitcoin went to zero, they'd be in debt. But they need cash, and they need cash to, run their operations, to buy food, and so on. And they want to arrange lines of credit. And since it used to be not too hard to do that, but since China cracked down, it's very hard. What they need to do is they need to buy long-term puts. They need somebody to come in and say, okay, I'll buy your $50 million worth of Bitcoin. If the price falls enough, I'll pay you at least $5 million for it. Because then they can take that put and they can go get a $5 million line of credit and they can run their business. But they can still keep all their Bitcoin and all of the upside. They just pay a premium to this person to basically guarantee their loan. On the other hand, some of these big Bitcoin holders, so you got $50 million. You never really expected to have $50 million your whole life. The rest of your portfolio is worth maybe $100,000. But you love Bitcoin and you want to keep it. But you'd sell some of the upside. You'd tell somebody, look, okay, I got 50 million of Bitcoin. If it goes over 75 million, you can have everything over 75 million. I don't care, because if it goes to 75 million, I'm so much richer than I ever wanted to be. That's great. And you'll pay me $1 million for that option. That's $1 million I can go and, buy a nice house, pay off my credit cards, whatever. I think these are the sorts of people who would have tremendous demand for options. And I think there are plenty of investors who'd like to take the other side. There are plenty of investors who would like to buy in the upside of Bitcoin without putting up too much cash. And there are plenty of investors who are willing to guarantee the downside in order to get a nice yield.
What do these derivative products, how do they open up the market above and beyond what an exchange like maybe Gemini does? Gemini is in New York, it's regulated, they're a custodian, you can do very large trades on it, I guess. And from my perspective, maybe not from an institutional investor's perspective. Why is an ETF needed? Why are derivatives needed? And what's the incremental value that they provide?
Well, first of all, I don't want to say anything against Gemini. I mean, it's a nice exchange. It does about 3% of global volume. But you say it's regulated. Yeah, it's regulated by the New York State Department of Financial Services. And with all due respect to New York State, they're not the A-list regulator in this regard. And there's a reason they went to, that one instead of going to the Securities and Exchange Commission, who would not have been so accommodating with them. So I would call it sort of, borderline regulated. And you can't really do large size. If you want to do large size on Gemini, you have to find somebody on the other side. You have to agree to the transaction off the exchange and then go execute it. And by the way, that's a good portion of LedgerX's business. I think that business has moved to LedgerX, where you settle on the clearinghouse, but you don't really use the exchange to find a counterparty to the trade. If you want to do, so I don't know if do you invest in Bitcoin personally?
I do, yeah.
You have a Coinbase account or something like that?
I've got several accounts.
Okay, fine. So I won't say you have to need a PhD in computer science to do it, but you need to know something about cryptocurrency keys and cybersecurity and so on. So lots of people don't. And also it's a little inconvenient. If you were doing trading where you wanted to, move some money from your Schwab IRA to this and back and forth quickly, it's more cumbersome than switching between two mutual funds. One measure is, the Bitcoin Investment Trust at GBTC, which has traded at a premium of as high as 140% over the Bitcoin it actually owns. So people are willing to pay a big premium to own these things in convenient, regulated financial form that they can trade and, buy and sell just like other financial instruments. That's a use case for individuals. For institutions, there's all kinds of things that are a real headache if you wanted to put Bitcoin in your portfolio. You have to value it. You have to pay taxes on it. You have to know the price. You have to be able to buy and sell if you need the cash. You have to know your customer. You can't transact with. You have to know who you're trading with. And for all of these things, you really need a clearinghouse. It is true there is a company called DRW that will assemble. If you're an institution, you say, okay, I need $100 million of Bitcoin. They will assemble a portfolio for you and deliver it. But that's a pretty cumbersome process compared to what, buying stocks and bonds. So LedgerX and CME and Cboe are trying to make it as easy to transact in Bitcoin as it is for stocks, bonds, commodities.
What are the different types of derivatives that can exist? I know LedgerX does swaps. CME Group is offering futures contracts. What else could exist, and what do you think isn't planned for yet, but perhaps should exist?
Okay, well, LedgerX has day-ahead swaps, so they're really a clearing facility rather than what you would normally think of as a derivative.
Clay here to explain what day-ahead swaps are. A swap is a derivative contract through which two parties exchange financial instruments. So, for example, one financial instrument could be the US dollar, and that could be swapped for another financial instrument, which would be a cryptocurrency. So a day-ahead swap is where the price is agreed to on a given day, and the swap occurs the following day.
And they also offer calls and puts. CME and Cboe are initially coming with futures that will be longer-term futures, and I have no doubt they plan stock puts and calls as well. I think there would be considerable demand for certain kinds of swaps. So, for example, let's say you're a Bitcoin investor, but you want to earn, Bitcoin doesn't pay a dividend, doesn't pay coupon payments like a bond. You just hope it goes up in price. You could use it. You could sell calls against it, and it would be very convenient to have a swap strip, a swaption. So you earned a steady return holding Bitcoin in return for which you gave up some of the upside. Other people would like a similar product on the downside on a swap, so they could maybe put $10,000 in Bitcoin, use it for transactions and such, but be guaranteed they could always, sell it for $8,000 or something like that if the price of Bitcoin went way down. I think these kinds of things would allow people to use Bitcoin, and it turns the volatility from a disadvantage. And one of the reasons people don't like using Bitcoin is the volatility. But if you're selling options, you're actually gaining from that volatility. So you're actually getting paid a higher yield to hold it. And it, I think, would stabilize the price, would make Bitcoin much easier to use as a currency, as an actual medium of exchange, or as a store of value for that matter.
Let's dig into regulation a little bit. What do you think are the kind of differing agendas of the SEC and the CFTC? Is it, again, I was saying the gold ETF was approved in the 1990s. Is this just kind of a stepping stone towards SEC approval? 3 questions, we can address them separately, but what are the differing agendas of the EFTC and the SEC? Is this a step along the way? And what happens to these derivative markets when an ETF opens? Is there a potential that people just sort of flee them and kind of go towards SEC regulated products?
I'm talking in general here. So the FTC, think of them as like the boxing referee. They just want to make sure there's a fair fight. They're not interested in, protecting the fighters. They just want to make sure that things get fair. The SEC, think of them as they're the ones who want to make sure nobody gets hurt. And they don't really care, they're not so concerned about, is there going to be a fight at all? Or is it going to be fun for the fans? Anything like that. And there's a third regulator here, too, we should talk about, which is the Fed or the Department of Treasury, or you can think of it as the U.S. government. And I'm not really just talking about the U.S. here. I think in every country in the world, every developed country anyway, you have the same 3 sorts of consideration. So the CFTC says, can we treat Bitcoin as a commodity? Is it well-defined enough that people can make bets on it and we know how to settle them? And we're not going to get all kinds of, clearinghouse collapses and bankruptcies and lawsuits. Is it something people can bet on? We're talking about experienced people who can look out for themselves. We just want to make sure that the game is something that can be well-defined. I think that battle has been won. I think the CFTC has come out and said, okay, you can either, if you do what LedgerX did and you do 100% collateralization, or if you're a well-organized, exchange with policies and procedures and infrastructure we trust, you can treat Bitcoin just like a commodity, just like it's gold or oil or anything else. It's a real thing. If you wanted to set up a futures contract and monopoly money, they wouldn't let you do it. It's not a real thing. Anybody can create it. But as long as it's well-defined, the CFTC has pretty much said they have no problem with it. I think this is generally true of exchange regulators throughout the world. In terms of investor protection, the SEC kind of who can invest in it. The SEC isn't never going to stamp out Bitcoin or outlaw it, but it might say, look, you really can't use this in institutional portfolios. You can't have an ETF. If you put it in pension funds, you're going to have all kinds of, it's not illegal. We can't stop you from doing it, but you're going to run into all kinds of problems. Unless the SEC comes out and says, okay, here's what Bitcoin is. Here's how it's regulated. Here are the rules in terms of know your customer, in terms of market manipulation, what's insider trading with Bitcoin. Nobody knows. All of these things you have to define for institutions to be really comfortable holding it. And again, this is an international thing. If the SEC defined it, that would probably be taken as an international standard. But it's possible the SEC will decline, but you'll be able to trade them freely in London or Tokyo or something like that if those regulators are more accommodating to it. And those regulators have basically so far said no. They have basically, no regulator has stepped forward and said, okay, we understand Bitcoin. It can be traded in a protected, regulated space where, individuals can buy it and we can put it in pension funds and things like that. And that's not required. There's no law that says you can't do it without that approval, but institutions are not going to go forward without some more regulatory encouragement. And finally, the sort of central bank, the Fed, the government, the Department of Treasury, the Department of Justice, their concern would be that Bitcoin can undermine currency regulation, can help tax evasion, can help illegal transactions, and so forth. So far, basically governments seem to be saying, it's okay. They have taken enforcement actions. They shut down Silk Road. They put the founder in prison for his life. They've taken enforcement action against individual uses of it. But countries like, Argentina, Venezuela, where a lot of the citizens are using it because their local currency is basically very unreliable, those countries have pretty much allowed it. And they seem to be taking the attitude that better to let people have this safety valve for it. So at the moment, it seems like that third leg of regulation says Bitcoin's okay. But in the long run, that's the most important one. In the long run, if countries really decide Bitcoin is illegal, Bitcoin is a way of evading taxes and currency controls and all the other things we want to impose, then, Bitcoin definitely becomes a sort of an outlaw currency. And that makes it more valuable to some people. The more governments crack down on things, the more valuable it is to be able to evade those controls. But it also means probably 95% of people are not going to dare touch it because it could screw up the rest of their lives. You almost have to kind of decide, are you in the underground economy and you use Bitcoin, or are you in the above ground economy and you avoid Bitcoin?
Right. Are you a cypherpunk? Are you a crypto anarchist? That kind of thing.
Those are people who would do it for political reasons, perhaps, but there are also people who want to do it they don't want to pay taxes, or they not for political reasons, but because they don't want to pay them, or they want to do transactions that governments make illegal.
I like your characterization of the three referees here, or the three regulators and their different vantage points. So kind of putting on your hedge fund manager hat here, you go to something like LedgerX to get exposure, but then an ETF opens up, or an OTC opportunity opens up that's maybe SEC regulated. How do you think of how you're going to make your bets and where they're going to be placed?
Well, I would certainly consider using an ETF if it were available, but I would probably go, if I were running a hedge fund and stuff, I would probably go directly to LedgerX. The question I'm going to ask is, there's pros and cons. An ETF would probably be easier to trade than actually executing trades on LedgerX. I'm assuming these are going to be physical delivery ETFs. That's, to me, the most likely form somebody would create them in. So these are going to be holding their Bitcoin somewhere at some custodian. So I'm going to say, listen, do I trust the custodian for the ETF more or less than I trust the clearinghouse at LedgerX? It's also quite possible that these ETFs would actually use LedgerX. They would love to use, if I were running an ETF, my preference would be to use the CME or the Cboe because those are going to be the cheapest and easiest for me. But at the moment, the SEC has said the settlement mechanism they use is not acceptable for an ETF. If I'm buying an ETF, I want it to be holding the physical Bitcoin, or I want it to have contracts at LedgerX or some other physically settled exchange. When you do a hedge fund, you typically, first you decide what you want, your economic exposure. Then you decide, okay, what's the cheapest way to hold it, or what's the easiest trading way to hold it. So I think ETFs and futures would probably compete with each other in the market in that regard. For an individual, the ETF is clearly the vehicle of choice. Also, though, people may at some point offer public mutual funds. Those would be, if people start doing diversified currency investments, I think those would probably come out in mutual fund format.
Right, like maybe something similar to the Metastable Hold Index.
Yeah.
Aaron, you've been super generous. I think there's probably few people in the world who could have answered these questions as coherently as you have. You've obviously spent a lot of time thinking about this. If people want to get in touch with you and, follow up with maybe additional questions or to connect with you, what's the best way to reach you?
There's two ways. You can certainly email me, but something that might be more productive for most of you, my Bloomberg columns have comment sections. And if you comment there, I do read them and I do reply if I have something to say about it. But you also reach a lot of other people who are interested in the same things. And you can see a lot of other opinions on that as well. So it's probably a better use of your time to put your ideas forward that way.
Fantastic. Thank you for joining us. I am really grateful, and I look forward to this episode going live.
Thank you very much, Clay.
That's it for this week. To sign up for our free crypto investing newsletter, listen to other episodes, or get the show notes for this episode, please visit flippening.com. I also invite you to check out the startup that funds this podcast, Nomics, spelled Nomics, at nomics.com. Finally, if you got value from this show, the biggest thing that you can do to repay us is to leave a 5-star review with some comments and feedback on iTunes, Stitcher, or wherever you listen to podcasts. Thanks for listening. I'll see you in the next episode.